All right, guys, what's going on? So let's get straight to the point. This one obviously is called Pay Yourself First. And what does that mean? Well, obviously it means pay yourself first. But if we break this down, essentially every time you get money, every time money is deposited in your account, you have a separate account that money goes to. Now, the ideal scenario is you're pre-taxing a lot of your capital into a retirement fund, which means that you're making pre-tax contributions, reduces your taxable income, and puts money away into a retirement account. The downside to that is when you put money in a retirement account, it's basically trapped there. Alternatively, you have a post-tax option, which is that you have maybe a savings account, you have an auto draft. What I recommend is when you're starting out, set up a savings account if you don't, or another checking account or whatever it is. You have a sacred account. And what I mean by a sacred account is money goes in, money does not come out, except for, whatever your stipulations are. There might be a major purchase or something like that. But ultimately the money goes in, and as soon as you get paid, that money goes into the sacred account, whatever percentage. You can start with $50 a month, $50 a week, $100 a week. Ultimately, you want to start with whatever's comfortable. You will realize you don't miss that money in your checking account, and you will be less tempted to spend the money that you do have in that checking account, and your other account will grow. And basically, what you're doing here is you're reallocating that capital as soon as you get paid, and that's why I say pay yourself first. Now, there's a lot more to this, but basically, in one sense, having money, first of all, is the trick to tricking your mind into thinking that you have more money and believing that you have money and knowing that you have the safety and comfort of some padding, right? It causes you to start being more aware of the money that you have, how you spend it. And so there's a little psychological trick there, but this is best played out in multiple arenas, and that is max out your pre-tax contributions, build your retirement, and have a post-tax savings plan. So whenever you get paid, when you have income, obviously it goes into that sacred account. Now, if you're a 1099 contractor or you run a business and you have, you get paid not through W-2, you want to make sure that you have another account where you figure out your tax withholdings and put some cash away into a separate account for taxes that's separate from your personal money, to make sure that you have capital aside for your taxes. Now, what most people get wrong is it just, here's the average person, right? I'm just going to give you kind of like the average person based on the minimum amount that we've been taught about money. They have some sort of a job. The job pays them a paycheck, and the paycheck goes into some sort of a bank account, right? Most people live everything out of this one bank account, right? So the money is just constantly flowing out of this bank account to other sources. And obviously, what I'm saying here is at least have another account that you can flow some of that money to, because otherwise you're just going to spend all your money, right? The tendency for most people is literally just spend the money, pay their bills, and then they overspend in other ways because the money is there and they don't have a contingency plan. So the first thing is set up your contingency plan, savings account, etc. So remember, this was the job. This was your checking account. And so this was your job. This is your paycheck. And this is your checking account. Right. So the other thing that you want to set up is when you get paid, if you have a retirement Of course, you want to pre-tax some of that into 401k, IRA, retirement account, whatever it is. It's going to reduce your pay a little bit, but it's also going to reduce how much you pay in taxes, and that money is going to be investable in some ways. Now, again, like I said, there's limitations with this depending on your company, 401k, your option as far as what you can invest in is limited. There are solutions to that, but until you have, a good amount of money in here, I'm not going to get into that. Essentially, you can create a self-directed 401k, which then you can invest in other things like real estate. But for this module, for where we're at, we need to get you paying yourself first, which is, I want to stress that this is different from savings, right? Even though you're putting money into a savings account and you're saving it, but the savings mentality is always like, oh, save for emergencies, or this is my little siren, an alert, save for emergencies, save for a rainy day, right? Save for whatever, something, some sort of catastrophe or emergency. It's like you don't want money piling up with the intention of being used for an emergency or some unforeseen circumstances. Because the other thing that I would say esoterically about money is that it's a container for your intention. It literally it holds intention because it's not real. It's man-made. It's literally a representation of thought. It's an idea, right? Esoterically speaking. So, what you want to do here is that this is just savings account. The way that I would refer to it is like a financial freedom account, because maybe you want to save up to buy real estate, or you want to save up to invest in a business. So we'll call this the financial freedom account, and that financial freedom account can be a savings account, a checking account, or whatever. Another thing that I will talk about at some point is another type of account. Could be a whole life policy or an IUL, which I'd recommend that you Google that, because essentially it's a form of insurance policy that you put money in and has all sorts of benefits, and it basically functions like a bank account. But on top of that, it's immune from lawsuits, seizures, et cetera, et cetera, et cetera. So it is a whole life policy or an IUL, basically an insurance product that functions like a bank account and gives you all sorts of other protections. But for getting started, pay yourself first, savings account, whatever you can do. If you can auto draft it, that's even better. 50, 100, 200, 500 a month, whatever you can do a week, the more the better, right? Because you want to, the other thing you're doing at the same time is you're looking at how to reduce your waste, right? Because there's a lot of waste that occurs here, wasteful spending that can be eliminated, that can be essentially removed from the equation, right? You're no longer wasteful. You're looking at your accounts, you realize where your money is going, you're being more conscious of what you have available, and when that number's lower, you spend less, right? Even though the number over here goes up higher, but you don't spend this account. So the psychology changes around your accounts and around your money. And this is probably the most critical thing that anyone should do if they're not doing. You may have this set up in some form or fashion, but I'm really driving home the way that I'm contextualizing this so that you understand why you're putting money there, how you're putting it there, what it's there for. It's ultimately there to invest in yourself in some way, to buy assets, to invest towards your financial freedom. Is not there for emergencies and rainy day or whatever it is. Like, you don't want to track those things based on your ideas, considerations, and intentions, because that can happen. So pay yourself first, pre-tax as much as you can. Now the caveat here, if you are self-employed and you make a good amount of money, you want to look at a SEP IRA, because you can pre-tax as much as, I think it's like $50,000 a year, $50K pre-tax. So you're making money and you don't want to pay taxes, bam, 50K a year, reducing your taxable income. Talk about a hack right there. As you're coming up as a self-employed, or that's why I recommend everyone have a small business, form a small business, and look at, even if you lose money, eventually you make money. If it has to be a real business, but you can write a lot off from that. So, but again, we're talking about paying yourself first. Why the psychology is you pay everybody else. Now, that's not to say, I would also say prioritize who you're paying, right? Of course, me as a real estate investor, I prioritize paying the property first. Your biggest expense, it's not a surprise. You know it's there. Pay it. Pay yourself first, then pay that, and then everything else, can be a lot more flexible. So again, so you have your operating account, you have your financial freedom account, maybe you have multiple accounts. Could be another checking account, a business account, whatever it is. Send that money to as many places that is not your operating spending account as possible. So to simplify that, pick a number you're comfortable with. As soon as you realize that you don't miss that money and that you like having it in the other account, then increase the amount. And so you're just going to start doing that. And then as soon as you realize that you can increase it, whether it's $10, $20, $100, $1,000 a month, get up to the point where you're saving between your pre-tax and your paying yourself first, where you're saving $1,000, $2,000, a few $1,000s a month, it's going to change your life, obviously. But even the idea of saving $100 for some people is complicated, or it's like emotionally, it's not possible. There's never enough money, whatever it is. I guarantee once you start doing this, eventually there's going to start being more money, because the problem isn't your income. The problem is your management of your money. So for those that applies to. So pay yourself first. You deserve it. You worked for the money. Learn how to value the money that you have. And then I want you to come back in a couple weeks, review how much you're saving, and increase it.